Germany, long the symbol of fiscal discipline in Europe, is changing course. Its new government plans 46 billion euros in corporate tax cuts and over 1 trillion euros in debt-funded public investment. This includes defense, digital infrastructure, and direct subsidies to revive German industry. To fund this, Germany is increasing its bond issuance. In 2025, the government plans to issue 62.5 billion euros in bonds and 30 billion in bills in the second quarter alone. Yields on 10-year German government bonds have risen to 2.51%, the highest in over a decade. So why is Germany doing this? Because its economy is struggling. Corporate investment remains 9% below pre-pandemic levels. R&D spending lags behind the US. Energy costs remain among the highest in Europe. Meanwhile, China is flooding global markets with cheap electric vehicles and batteries. And looming over it all is the threat of 50% US tariffs on European exports. Now Berlin is moving fast, cutting taxes, subsidizing electricity, and slashing red tape to save its industrial base. But Germany isn't alone. This is now a global fiscal shift. The US is doubling down with what many call the Big Beautiful Bill, a sweeping package of tax cuts and industrial subsidies expected to add over $2 trillion to the deficit. It's designed to outcompete China, defend American manufacturing, and juice growth heading into the midterm election. China continues its industrial surge, controlling over 70% of global EV battery production and funneling nearly $500 billion a year into strategic sectors. And Canada is joining in. Under Prime Minister Mark Carney, Canada is launching a clean industrial strategy with billions in tax credits, green incentives, and subsidized loans. But there's a problem. Canada's spending is outpacing its growth. Over the last decade, Canada's population rose 15.8%, but federal expenditures surged by nearly 95%, from $250 billion to $486.9 billion. Revenue isn't keeping pace, and public debt charges are climbing. The CRA's budget appeared to drop sharply this year, until analysts realized the change was due to discontinued carbon rebates, not actual cost cutting. Without restraint or reform, the country is heading towards structural deficits, and that means future tax hikes, capital gains, home equity, wealth taxes, all are back on the table. We are entering a new era, especially outside the United States, where governments are no longer just regulating growth, they're sponsoring it. Fiscal policy is now the first tool, not the last. And while the long-term results remain uncertain, the cost of doing nothing is clear: fall behind. But there's something else happening too, in the markets. For decades, the US was the global default for capital. But in 2025, that's starting to change. Trump's renewed trade war, paired with a $2.4 trillion tax package and rising deficits, has triggered a rethink among big institutional investors. The US dollar is down nearly 9% this year. The S&P 500 is nearly flat, while Europe's Stoxx 600 is up 9%. A Bank of America survey shows the biggest underweight in US assets in 20 years. AllianceBernstein's CEO called the US deficit path untenable. Canada's second-largest pension fund is cutting US exposure and reallocating to Europe. Neuberger Berman has shifted 65% of its private equity co-investments to Europe, up from 20 to 30% in recent years. Even Oaktree's Howard Marks put it bluntly, US exceptionalism is starting to look less exceptional. The message is clear. Wall Street no longer looks risk-free. And for the first time in decades, investors are looking for alternatives. Which brings us back to the central question. What actually works in this new era? Subsidies can buy time. Tax cuts can ease pressure, but only innovation creates new value. That means research and development, not just factories. It means owning the future of services and software, not just protecting hardware jobs. It means building high-margin, globally scalable technologies, from AI to biotech to clean IP. The US runs a $310 billion services surplus and invests over 3.5% of GDP in R&D. Germany and Canada are far behind. And China's dominance in industrial capacity hasn't yet translated into services leadership. But history gives us the clearest lesson. The nation that leads in innovation wins the long game. We saw that in the United Kingdom during the Industrial Revolution, when steam power and mechanization transformed the global economy. We saw it in the United States during World War II, when America didn't just innovate, it provided geopolitical stability. And as it did, scientists, entrepreneurs, and capital followed, making the US the global center of progress for the next 70 years. And in the last decade, we've seen glimpses of this in China, where state-driven investment in infrastructure and advanced manufacturing reshaped global supply chains. Innovation doesn't happen in isolation. When governments invest boldly and lead with purpose, private capital and human talent follow. The risk takers show up. The builders take notice. The brightest minds place bets on the future. That's the opportunity Germany has created with its trillion-euro growth plan. If it commits to real innovation in green tech, digital infrastructure, and human capital, it could lead a new economic chapter for Europe. But if it falls back on old strategies, the moment will pass. Germany's fiscal flip may mark the end of one era, but unless it turns spending into innovation, it won't lead the next. The age of passive growth is over. The future belongs to those who build it. If you found this breakdown useful, consider subscribing for more global macro insights just like this, where policy meets markets and history meets the future. What do you think? Is Germany's pivot the start of a smarter economic era, or just a desperate response to decline? Let us know in the comments. Thanks for watching, and we'll see you in the next one.